Howdy and welcome to today's 5 with Fitz. There's a rebound underway as I record this, and no, it is not because markets have magically improved or tariffs have vanished into thin air. It's because the computers, those things, hit levels yesterday where buy programs designed to revert to the mean kicked in hard this morning to level things up. Brings up an important point. Always remember that price drives the narrative, not the other way around. So do not get sucked into the headlines like everybody else. They're temporary. And do remember that profits, on the other hand, are a permanent feature, which it comes to your money, which is why you want to focus on companies producing them, doggone it. So here's my playbook today. Number one, let's talk Tesla. Tesla reports later today, and many squeamish investors are driving themselves nuts trying to guess what Uncle Elon's got up his sleeve. To me, this doesn't have to be difficult, even though many people want to make it that way. In fact, it's a simple 3-part decision tree ahead of earnings. So you can watch that elsewhere on my channel if you want. I recorded that early this morning as I went to the gym, back from the gym anyway. But what I want you to remember as we head into Tesla's, no matter what happens, no matter what gets said, no matter how Wall Street tries to trash this stock, simplicity beats sophistication, especially when it comes to stocks like Tesla. Most investors and traders get smoked because they overthink things. So don't do that. It's just that simple. Now, trading ideas, I suggested 2 speculative trading scenarios for the One Bar Ahead family in yesterday's weekly update. And looking at the action this morning, a short-term straddle could work nicely too now they think about it. Point number 2 today. Breaking up Google now at this point in time would be incredibly stupid. Here's the deal. The DOJ, Department of Justice, wants to break up Google's Chrome and Android units as part of its search monopoly verdict. Now, I get it. And I'm no fan of Google or Alphabet, but this would be so incredibly stupid and short-sighted in the face of aggressive Chinese tech development. And this brings up something really important, straight from Dr. Alex Karp's playbook, and I agree. If you haven't read CEO of Palantir, Dr. Alex Karp's book, The Technological Republic, you consider yourself a serious investor, I encourage you to do that immediately. It will change your thinking, and I submit, for the better, and dare I say it, far more profitable too. Number 3, it's not often that I agree with Jim, as in Jim Cramer. CNBC's Jim Cramer says the current market downturn is eerily similar to 2011, not based on earnings, but based on man-made pressures. Now, we've talked about this in the past, so Jim, it's nice to have company. Thank you for reinforcing my point. Back then, it was the Eurozone debt crisis. Now, it's domestic instability, debt ceiling fears, political theatrics, tariffs. I mean, you name it. There's a dozen different influences, but they're all man-made. It's not often I agree with Jim, but in this case I do. Now, the headline are interesting. The investing tip that goes with them, I think, is quite challenging, but also very important to understand. When the headlines scream panic, you want to lean into discipline, not drama. Number 4, drugs made in America. It's happening, and not those kind of drugs either. Swiss pharma giant Roche is pouring $50 billion with a B into U.S. operations over the next 5 years, building out AI-driven R&D hubs, a 900,000 square foot manufacturing site, and creating 12,000 plus jobs. Why now? Because, big surprise, U.S. President Donald Trump has pharma tariffs on deck. So, like them or not, right or wrong, that's not up for debate. What matters is that multinationals like Roche are scrambling to de-risk their supply chains. Roche says the investment will eventually flip its U.S. drug exports higher than imports. I agree. That makes sense. Contrary to what many people want to believe, the next global pharma wave of growth may be made in America, under pressure, but with a purpose. That brings up an important related point. Money is like water, something you hear me say all the time. Money is like water in that it will always flow to where it's treated best. This isn't just about tariffs or headlines. It's about positioning for the future, and Roche knows it. Also, like us, Roche knows that AI is reshaping drug discovery. Personal medicine is scaling, and reshoring, onshoring, whatever you want to call it, will be an extremely profitable move, both for the company and for investors who are smart enough to get on board. I say that because next-gen pharma will be faster, smarter, and closer to home, something we've been talking about for a long time. Now, most investors still don't grasp just how game-changing this really is, and at the risk of sounding self-serving, this is exactly the kind of investing theme we've been tracking for years in One Bar Ahead, our paid research. You can find out all about that later if it's interesting. Hopefully, it's on your radar and you're investing accordingly, but if it's not, you know where to find me. Now, number 5, Walmart v. Target. Walmart, Target, and Home Depot execs were recently called to weigh in on sweeping new tariff proposal, and not all retailers are built the same. I think, and I think this for a while now, I've thought this for a while, Walmart may just come out of this stronger. The best companies almost always do. 2/3 of what Walmart sells is sourced domestically, which means fewer supply chain disruptions, better pricing control, and more insulation from any tariff-driven inflationary shocks. Target, a company I'm often asked about on the other hand, has far deeper exposure to overseas manufacturing, so it means it's staring down a steeper slope and a very slippery one at that. Now, I've highlighted Walmart as the better choice for years with good reason. Operational resilience, supply chain strength, and margin protections aren't just buzzword in my world. They're real investable advantages, and that's what I want you to understand. Now, how real? Well, think about this for a second. Since I first brought it to OBA members' attention, Walmart has returned 50.62%, while Target is down, having lost 33.78%. So I'm just saying, you got to focus on the quality in the companies and the names that matter. Now, Keith's investing tip with regard to this one. People think investing is nothing more than picking a hot stock, but that's simply not true. You've got to constantly weigh alternatives and have a very short buy list. Anything else is a risk you don't want in your portfolio, or at least I don't want in mine. So today's bottom line, people are so busy trying to predict the unpredictable that they forget to focus on what's profitable. This doesn't have to be complicated. The markets don't reward those who guess the best. The advantage always, and I mean always, goes to those who think and act with clarity while others freeze in fear. As always, and on that note, make it a great day. You got this, I promise, and I will see you tomorrow.